Good afternoon or good morning if you're in California, like our speaker is today. Welcome to MSO's second webinar of 2025, The Dangers Lurking in Claims Made Forms, presented by Frederick J. Fisher. I am Sue Quimby, Senior Vice President of MSO Inc. Joining me as host is MSO CEO and President Jan Seitz, and providing technical assistance are Mary Beagle and Cassidy Cody. Sponsorship opportunities are always available. Contact us for information. Claims made forms have always been interesting and difficult for many people to understand. So hopefully with our expert today, we'll gain some insight and knowledge that will help us as we deal with these. Frederick J. Fisher, JD, is president of Fisher Consulting Group. He's a licensed P&C adjuster and agent as well as surplus lines broker. He's been dealing with claims made policies for 50 years. He's also a certified claims professional. He is very active in numerous industry organizations and committees, including the Professional Liability Underwriting Society, and he is a member of the International Association of Insurance Professionals as well. Copies of his presentation will be available upon request. Frederick, you probably have other things you want to say about yourself, so go ahead.
Well, I've been in this industry for a long time, obviously, and I was all about providing financial security to my customers, and we delivered that expertise every day for the 25 years that I was a broker, and certainly even as a claim adjuster, we bent over backwards to see how we could provide coverage as opposed to deny it for a lot of different reasons, not just the expenses involved either. But the long and short of it is, if you're interested in the financial security of your customer, then you know exactly what the problem is, and you also have the solution available. And that's what we did every day. So that's a little bit about me. But believe me, I know where the gotchas are in policy forms. I've read so many of them in my career that I know exactly where to go, and I know exactly what the how tricky some of these things can be. And we're going to find out about that rather now. All right. Let's talk about the dangers lurking in all claims made policies, because believe me, they are tricky policies, and they're designed that way intentionally. So from that perspective, let's start with this. Begin with the assumption that a product that's sold to a policyholder is how it responds when a claim is submitted. Because up until then, no customer is going to know whether they actually got a good policy or not. And that's when they submit a claim, that's not when they want a surprise. Number two, let's assume that actuaries in setting pricing, as we see here, use historical data and other research, but they miss one important additional factor. And we'll get to that. But the real question is, does the product meet the reasonable expectations of a policyholder when he's being covered as an attorney or a director and officer or even a homeowner? We all know what are usual and customary things that would normally be covered, and yet maybe they're not. So the product is how an insurer responds and whether or not they're supposedly living up to a reasonable expectation. And you should have that to eliminate uncertainty. But eliminating uncertainty increases the probability, of a profit, believe it or not. Nobody wins in a lawsuit, period. Nobody. They're expensive, let me tell you. You cannot defend a routine case anymore for under $100,000. It's very difficult to do that. Profit, okay, should be a result and not the original goal. You make a profit by providing a good product, not by just doing everything possible not to spend any money. And so in reality, how does this work in the real world? Well, let's talk about insurance for now, right? That's what we're here for. This is a very common, insuring agreement. Policies written on a claims made and reported basis. The vast majority of forms today are. Not only must the claim be first made against you during the policy term, but the insured has to report it to the company during the policy term, or, subsequent to a retroactive date. And of course, claims are first made against you and reported to us while the policy is in force. Okay. There's no coverage if you report it after the end of the policy term. And here's the key tricky language. Unless and to the extent an extended reporting period applies. Now that's pretty common. there are variations. One of them, unless and to the extent an automatic extended reporting period applies. Some policies use that language, but that's the problem. Let's remember, we're on page 1 of the deck page, or maybe we're on page 1 of the policy with this language, and all of a sudden now you got to shuffle and see, well, what does the extended reporting period say? Well, here's the thing. Here's where the tricky language is. In the event of cancellation or non-renewal, then you have an automatic extended reporting provision. Right there. Remember, we haven't gotten off page 1 of the policy, but now we're at page 14 where the extended reporting language may appear. And of course, you also have, you may have an additional 60 days. But remember the condition. In the event of cancellation or non-renewal, you've got an extra 30 or 60 days to report a claim that was made right before expiration. So what if the company renews? What if you renew coverage? That means this condition is not satisfied. The policy has been renewed. It was not canceled. You do not have an extra automatic extended reporting provision with this language. So in reality, what does that mean? It means that a deadbeat policyholder who's either being canceled or not renewed because of bad claims, or an unloyal policyholder says, oh, I can get it cheaper from another carrier, and he moves. He's got more time to report a last minute claim to the carrier than a loyal policyholder. And you'll find this in almost every single policy. And even though there may be another condition we'll get to, but that condition of duties in the event of claim or suit, sometimes you'll see all claims must be reported during the policy term, but no event later than 30 or 60 days after the policy expires. I got news for you. You may think that creates a conflict, but a case in Florida said otherwise. And that was James River versus Garcia. They only looked at this provision. End of story. He renewed the policy. There was no coverage for a claim that was submitted 3 days after the policy renewed. Take it to heart. Another insuring agreement. Pay on behalf of the insured in excess, you can see what it says, because of a claim first made against the insured and reported during the policy period. So what do you think? Think there's a gotcha in there? Well, let's talk about that. Here's the language, but you can see in the red, obligated to pay as a result of claims first made during the policy period reported to the company or within a 60-day automatic extended reporting provision. You will not find that language in most policies. There's your carve back. There's a saving grace. That takes care of the definition, that we saw mentioned earlier about what if you renew? Well, this takes care of it because this is now referring to, the same language that you find in the duty in the event of claim or suit. So this is really preferable language. Try and find a carrier that uses it. Okay, the 60-day ARP is great, but what about automatic extended reporting provisions? There's so many variations to this. Here's another one that, has serious restrictions. If the policy is canceled or not renewed, or we replace the policy when it has a retro date later. Okay, so now you've got extra time. But again, that begs the question, what if these conditions aren't met? Then you don't have extra time to report a claim. So here's some recommended language if you can get a carrier to even do it. And we haven't gotten off page 1 yet. We're still page 1, but now we had to go to the extended reporting provision language of the policy, which is in the condition section, which is usually near the end of the policy. Not every policy is laid out that way, but a lot of them are. So these are some gotchas, and we're not even off page 1 yet. We haven't even gotten the definition section yet. How much fun that's going to be. Okay, so this is a gotcha you got to be really concerned with, because if a policyholder renews, if something happens right before the due date, the anniversary date, like they're served in the parking lot or a lawsuit's filed and they don't even know about it yet. Remember, this is a claims made, most policies are claims made and reported to the company during the policy term. These are gotchas that are going to give rise to a lot of litigation, and that's something no one wants. Okay, you don't want to have a law. It's bad enough you got a lawsuit against a policyholder. It's worse when he's got to have a fight with his insurance company at the same time. So let's talk about the convergence of issues. Policies on a claims made and reported basis. Okay. Now we got a claim definition, means a written demand for monetary damages arising out of or resulting or to perform professional services, however that may be. And then you got this language: in the event of cancellation or non-renewal, there's that condition. And here's the notice of claims provision I mentioned earlier, where, okay, so now this gives you 60 days after, and there's no condition on this one. So you would think that the notice of claim provision conflicts with this provision. That creates an ambiguity that's going to be determined hopefully in favor of the policyholder. And guess what? It may not get that far. James River versus Garcia dealt with this very issue. Now, it's one case in Florida. I don't know how other states might deal with it, but the point is, you don't want these problems to begin with. Nobody wants litigation. Nobody wants to have a declaratory relief fighting with an insurance company while they're being sued by a third party. And believe me, the broker may be in the crosshairs as well. That's the problem. And then this issue, keep this in mind, because this ties up together everything we just were talking about. The difference between claims made and reported, the problem with an extended reporting provision that deals with the last minute claim, and they do happen. And of course, the notice of claim provision. They're not consistent with each other. What is consistent, however, is you'd be surprised how often a last minute claim takes place, or the insured suddenly realizes we could have a claim against us. This is what I call the safety net, that you can use duties, to the where you can trigger a claim if you report notice of circumstances. But when you're dealing, and we'll get into it later, if you know of a potential claim, you have to report that potential claim before the policy expires. There is absolutely no extra time to do so, unlike a real claim. But that begs the question: what's a claim? Here's some more dangers. How the word claim is defined. And there's absolutely no standardization. Claiming can mean a written demand for money damages arising out of professional services, or claim means a written demand for loss, or a wrongful act, or any suit. That's another one. There are so many. Another version. A claim means a demand for money or services as compensation for a wrongful act. Boldface, which means what's a wrongful act? Or it could be a disciplinary proceeding, and again, involving a quote unquote wrongful act. Any request to toll the statute of limitations. Okay. And another one could be, that is not here, a request to a subpoena for your file. That could be in the definition of claim. So that's one of the most important things in any claims-made policy is, how is the word claim defined? Originally, there was no definition. The definitions, my earliest policy goes back to 1972. Word claim wasn't defined. You didn't start seeing definitions of the word claim in policies until the early 1980s, for the most part. And then, of course, you got this one: a claim shall be considered first made when any insured or the insured's legal representative first receives notice of a claim. Okay, what may be missing? Here's more definitions. There's 5 of them here. These are all from real policies. And you're going to see them all the time. So if you look at these, there's one thing missing. And right here, number one, we got time bombs. But let's go back to the original question. What's missing? Not one of those definitions requires notice or knowledge by the insured. The filing of a lawsuit triggers the policy, not the service. A written demand may or may not have been received. Commencement of a governmental proceeding can trigger a claims-made policy if it's in the definitions, such as a grand jury. And yet the insured doesn't know about it. So here's the problem. If this is a claims-made and reported policy, which most policies are today, you very rarely see a claims-made policy anymore. Now they're almost all claims-made and reported to the company during the policy language. So now that that's required, if the definition doesn't require knowledge of the insured, a lawsuit served on the insured, a subpoena served on the insured, a grand jury proceeding where the insured is aware of it. How do you report something you don't know about? And you'd be surprised how often this takes place. 4 states, New York, New Jersey, Florida, California, have all had situations where a director and officer liability policy was triggered because it was a governmental proceeding. A grand jury issued a criminal indictment against the directors and officers, and then the indictment was sealed. And it was not unsealed and served on the insured until after their D&O policy had expired. Guess what? Denial upheld in 4 states. I like that one. I don't know how many of you write director and officer liability, but you sure want to look at that. So reporting of claims becomes really important. But here's another problem with these. This one, reporting of claim and potential claim, insured may have up to, but not to exceed 60 days. Okay, fine. But we've already discussed the condition, cancellation and non-renewal. So is this language in the insuring agreement? And if it's not, I don't know if a court's going to enforce it. I have seen some policies take the reporting condition with a 60-day tail on it and put it in the insuring agreement or refer to it in the insuring agreement, but not necessarily. Not necessarily. Now, 30 days to report a claim right here. So it's not a claims made and reported policy. It's a claims made and reported in 30 days policy. And more. Potential claim incident reporting. This is a safety net. As we all know, if you know of a potential claim, one of your employees has come to you and says, oh, gee, we screwed up, we might get sued. Or you discover it on your own. Or you're an attorney and you just got notice that you hadn't filed a lawsuit on time and a default's been taken against, or you haven't filed an answer on time and a default's being taken. Or you've blown the statute of limitations. Now you know of a fact or circumstance that could give rise to a claim. If you report it in specific detail, then you can trigger the policy. A lot of people believe that, oh, no, I don't want to do that. It's going to raise my rates, and I can probably get that default set aside. And so I'm not going to say any word about it. So on renewal applications, they're neither aware of fact or circumstance that give rise to a claim. They try and get a default set aside for 1.5 years. So they've been through 2 renewals, and they again denied, oh, we're not aware of anything going on. And then finally, they run out of time and said, okay, well, we're dead. We're fine. We'll send it in now. We'll report it. And guess what? Claim denied. Claim denied. You knew about it. You knew about a problem. You were trying to fix it. You never disclosed it. You lied on your application. Some courts will even whether asked or not, they'll even rescind the policy, which means that the law firm now lost its prior X coverage. That's how strictly these things are being enforced. So I know a lot of retail brokers, and certainly we encouraged it, and we did it ourselves as wholesalers. We would send out with a binder, a reminder, please report all claims or potential claims immediately to the carrier involved. Immediately. We did it with renewal letters. We did it with binders. We did it when we delivered the policy. Please remember to report all claims and all potential claims. A lot of people still think, oh, no, they're going to raise my rates if I submit a potential claim. Well, that's not true. It's not true at all. I know a very large architectural firm and engineering firm. They do design build. They're involved in environmental projects and fracking or water treatment plants and construction. They report over 200 incidents a year. 200. They've never had a policy increase because of it. 99.9% of those reports never turned into a claim. Never. But they reported them. They reported all incidents. So that's a very interesting problem. But, and it gets magnified on scale. We'll get to that. So here's incident reporting time bomb, though. Be aware of this. Here's a gotcha. You must provide written notice to our appointed representatives in 30 days, but in no case later than the expiration of the policy when anybody, including your in the management or supervisory level, is aware of a potential claim. So it's not a claims made and reported policy. It's claims made and report in 30 days once you know about a potential. That's dangerous, that limitation. It also could apply to an actual claim too. Some policies do say once you know about a claim, you've got 30 days. I've seen it as short as 10 to report it. Some say you can't report it if there's less than 20 days to respond to that lawsuit. Because, you usually you have to file an answer in 20 days or 30 days. So some restrictions now, once you have a claim made against you, you better send it in to us right away because we need at least 20 days or more to respond, as opposed to let's call an attorney and get an extension, which is so easy to do these days, always has been as a courtesy. But still, those are time bombs and they exist in the condition section. So remember, we barely gotten off page 1 of the policy. So you got to wonder how many other gotchas are there, but take these gotchas seriously. They're tough to find. Okay. So here's the ultimate gotcha: absolute exclusions. Now, normally I've written articles and I've got other seminars where I've focused on absolute exclusions, but now absolute language is popping up in claim made language. I've seen it in prior act dates. I've seen it in prior pending dates, which we haven't even gotten to that issue yet. But let's look at this. Any claim based upon or arising out of, in whole or in part, directly or indirectly, fill in the blank. They are being strictly enforced. And it may or may not be limited to the insured. As you can see, the word insured doesn't appear here, which means any claim based upon or arising out of discrimination is going to be excluded. So let me put that in perspective for you. Everybody here is an insurance producer. I assume you're selling EPLI policies to your clients. So what if your E&O policy, the policy you've got to protect yourself from claims brought by policyholders saying you didn't insure me correctly? What if you sell an EPLI policy to someone and something goes wrong and the claim is denied? So now the policyholder says, this is your fault. You didn't do what you were supposed to do. And so he makes an E&O claim against you. Under this kind of language, there's no carve back saying this exclusion won't apply when you're providing a professional service to a customer. It doesn't say this exclusion won't apply when you're providing insurance or a bond to a customer. This exclusion doesn't refer to an insured, meaning you. It doesn't say any of that. So if your customer sues you because the EPLI policy you sold them for some reason has a claim denied, they want to blame you for that. Guess what? The claim against you arises indirectly from a claim of discrimination, etc. And that will be enforced, and you don't have E&O coverage for the claim. I've seen E&O policies for insurance agents with as many as 14 different exclusions like this that doesn't refer to the insured, doesn't have a carve back when you're providing a professional service. There might be as many as 30 exclusions in your E&O policy, most of them dealing with the fact that other policies are supposed to cover this. That's why a lot of the exclusions exist in policies. It's because we don't want to cover what another kind of policy covers. But when it's not limited to the insured, when it doesn't refer to an insured, when it doesn't have a carve back for your professional services, or even language like this exclusion or exclusions A, C, G, L, Q, and S and T won't apply when you're providing professional service to a customer. So what about all the other exclusions where that not mentioned? And like I said, I've seen as many as 14 different types of policies that insurance brokers routinely sell every day that have language exclusionaries like this, which means they're not covered under an E&O claim, including bodily injury and property damage, environmental claims, EPLI claims, SEC claims. So it means if you sell a D&O policy that may get triggered or should have been triggered by an SEC problem, you're not covered. 14. I only know of 3 insurance companies, possibly 4, that sell E&O to insurance agencies that don't use, only have a few of these types of exclusions, and in some instances I know of two that don't. I will not, unfortunately, discuss that in a public forum. I will be happy to address it privately. But this is something you need to know. Look at your own E&O coverage and look at the exclusions and see if you've got absolute language. But here's the trick, and this is why I have it in here. I've seen this language now with retroactive dates. We don't cover any claim arising directly or indirectly or the alleged date of error is prior to X. Well, how's that going to be applied? They're going to be applied against the insured or anybody else. I've even seen it in prior pending language too, what's called prior pending date or continuity date, where it doesn't apply to the insured. So if A sues B, B sues C, and C sues the insured, if the A versus B lawsuit is before the inception of the policy or before the prior pending date, guess what? Not covered. I saw such language in a D&O policy issued by a major insurance company with a D&O policy with a prior act date, by the way, where they used absolute language. And then again, it didn't refer to the insured's error. It could have been anybody committing this. And then the insured gets sued for it. Well, why would you deny coverage to an insured involving somebody else over whom the insured has no control or even knowledge of? But that's how they're being interpreted. And the carrier won that on appeal. And I raised a stink about it on LinkedIn. And the vice president of underwriting, he sent me back, well, what if we told you we offered full prior acts? And my answer was, so? It's not the fact that there was a prior act date on a D&O policy, which is rare to begin with. It's the fact that the language used is so broad, it goes beyond the policyholder's actions. Another gotcha that'll get you. So, more ultimate gotchas, absolute exclusions, retroactive date language. You've discussed that. Here it is. Here's the prior pending continuity date language. You see that too? These are things that commonly are involved in claims made policies. So this is probably a good time to bring it up as any. So how many triggers are there in a claims made policy? It used to be simply a claim first made against the insured during the policy term, so long as no insured was aware of any act or wrongful act or incident prior to the inception of the policy. Pure claims made form. I'm the one that actually came up with the phrase pure claims made. First appeared in an article I wrote in 1990. So I'll take credit for that one. There's not a lot I'll take credit for, but I'll take credit for that. That to me came up pure claims made. So then the first thing that happened, you had retroactive dates. And so that limited coverage to a wrongful act had to occur subsequent to a retro date, which could be the date of your first policy, or it could go back 20 years. Actually, my E&O goes back to 1994. How likely is it that I'm going to get a claim today for something that happened in 1995? I have no idea, but it theoretically could happen, I guess. Okay. Then you had, so retro dates came next. Then you had the requirement that claim, be reported to the company during the policy term, which I originally called a hybrid in 1990. Now it's standard. Now it's rare to find a claims made only form. Now it's claims made and must be reported to the company during the policy term. And then some policies now have a prior pending or continuity date. Nobody can define that, what a continuity date means. Nobody can define what's meant by continuity of coverage. Even when an underwriter says, oh, well, if there is an incident, but they renew with us and then it becomes a claim, we'll cover it under continuity. No, they won't, because the claim department's not on that call. And the claim department's going to deny coverage, and they're going to win. It's already been decided, matter of fact. There was actually one carrier that he actually tried to define continuity, actually tried to say in a situation like that, they will provide coverage. But there was other language in the policy that conflicted with that, like the duty, to report a claim, as soon as practicable, but during the policy term. And guess what? They won. They were able to deny coverage. Even after there was an attempt to even have continuity, court said no. Look at the claim language. Look at the language in the claim requirements, and so that condition was enforced. That's a decision that's in many of the articles that I've written and what have you. So I'm not going to say they're lying to you, but you can't trust what an underwriter tells you anymore. they may believe what they're saying. And more often they probably do. But now what's happened is that the claim department and the underwriting department in many carriers, they don't talk to each other, they don't cooperate with each other, they don't confer with each other. Claim department's on its own. They're going to look at what the claim's about, and they're going to make a claim decision, and they're never going to talk to the underwriters. So whatever an underwriter told a policyholder, the claim department doesn't care. And I've seen it so many times. It's exactly what happened. So, I thought I should answer that. Well, anyways, be careful with this. All right, here's things that, the illusory policies, I call it. I love this one. Here's a gotcha that drives me insane. It's in it can be found in a workers, in many policies today. And it's a pollution exclusion. And it excludes a situation whether or not the insured either caused or contributed to the pollution. So the insured turns around and he sues their insurance broker and says, oh, I should have been covered for this. And it's like, wait a minute. Your E&O policy may have an absolute exclusion for, guess what? Pollution. So this is really kind of crazy. It's carvebacks based upon directly or indirectly arising out of the insured. See, this is what you want to see. But then you could have this language: this exclusion shall not apply to any claim brought against any insured for any actual or alleged failure. Okay. So we've discussed this, but this is language you need to see. And I love this one. With respect to exclusions E, F, I, and U, these exclusions shall not apply to a claim caused by your alleged failure. Okay, great. Those are carvebacks. But so what about exclusions A, B, C, and D? That's not mentioned. So how many of these things are there? An insurance agent and broker policy, as I mentioned, you can have as many as 30 or more exclusions. And if they're using absolute language, boy, be concerned. These are all gotchas that can get you, and they're in all claims made policies. But the real danger, of course, is the definition of claim, conditions, reporting requirements, etc. And and then there's some things coming up. It's going to be a lot of fun. But the real key here is to really do a deep dive. There's no two policies are alike. I've seen a company buy D&O and a separate EPLI policy, because when you couple the two together, the EPLI usually has a much higher deductible, because a lot of D&O deductibles now are $25,000, $50,000 or higher if it's a big company. So they buy EPLIs maybe included there, and so they've got the same retention. But it's possible to get a lower one. So maybe you get a standalone EPLI policy for that purpose. And the same with fiduciary liability, and of course, errors and omissions. You get a separate policy for that. Well, guess what? Every single one of those policies could have a completely different definition of the word claim. Because there's so many definitions they can have. So, and it's not uncommon, especially even if it's with the same insurance company, because the D&O department's got their underwriting group and policy language group, and the same with the E&O unit and the EPLI unit, and they don't talk to each other. And so even within the same company, they're not using standardized language throughout policy forms. and I think that's kind of ridiculous. I mean, really, a claim's a claim. So why not all use the same language as to how you're going to define it? Especially when you've got all the policies with the same insurance company. Sometimes there's crossovers and gray areas. So if you got a D&O claim, you might also have an E&O claim as well. Both policies might be triggered. So not having consistent language throughout the company, defining the word claim or defining the notice of claim or the policyholder requirements, these are all, fraught with danger and could give rise to a lot of litigation as to whether or not the policies are triggered and who's going to respond and what have you. So this is all kind of nuts. But bear in mind, the concept of an illusory policy, as I've called it, well, here's what the courts had to say about that. If only one type of claim is covered, it's not illusory. I like that. So you as an insurance broker who could be sued for selling what 50 different types of policy forms. Okay. And we already know that some of the E&O policies using absolute language may only cover you for 20 of them or 30 of them, not all of them. So what's that about? Kind of nuts, but but remember, this is also true of the James River case that started all this with absolute exclusions. Court said, "Oh yeah, we don't. They're not covered for anything they do environmentally, which is all they did, but they are licensed as engineers. So if they had done something else that didn't involve pollution or environmental, they'd be covered. So the policy's not illusory after all." That's what the court ruled. So the bottom line is, if one type of claim, just one, is covered under the policy, it is not illusory. So which means they could restrict the policies as much as they like. And I can tell you, it's intentional. There are actually law firms that are putting out articles that have said just as much. It would help you to hire competent coverage counsel to help you draft language so as to be able to avoid paying claims you normally would pay. We're not even talking obscure stuff here or iffy stuff. We're talking claims you normally would pay. We can help you avoid that. There are I know of 4 or 5 such articles that are out there from prominent law firms that are talking about how we can help you limit providing coverage. So why buy insurance at that point? It's crazy. Okay, let's talk about extended reporting provisions. This is again very important in claims made policies. And that really, and of course, what triggers an extended reporting provision? And some policies may actually have 2 sections, one for extended reporting provisions, one for what's called runoff. They do the same thing, but they're for different purposes. So let's just deal with the easy one first. Extended reporting provisions. Almost all claims made policies have them. And they're usually triggered by any number of things: cancellation or non-renewal. We already know. Or some other reason. But usually it's cancellation. You've had a bad loss history, we're not going to renew you. Or we'll only renew you retro date inception, what have you. So most policies, will say, well, if you cancel or non-renew, you can buy an extended reporting provision, which covers you for any wrongful acts you did before the expiration of the policy, so long as that claim is reported to us, however out in the future you buy. So that really begs the next question. Most policies will give a guarantee of 1 year. You usually find it on the declaration page that says ERP 1 year, 150% of the expiring premium or whatever it is. Some companies will do multi-years. I've seen it as much as 6. Okay, well, that's fine. Some policies don't necessarily do that. Some policies will say, we'll give you an extended reporting provision, and we will determine how long it will be and what it will cost based on our underwriting guidelines at the time you ask. Well, if you're being non-renewed because of claims, what do you think they're going to do? I've seen premiums for an ERP as high as 800% of the expiring for that very reason. So what's the better way of doing it? Say, I want breakdown up to 6 years, and I want the pricing set in stone before we buy this policy. Get a multi-year quote. You may not be able to get 6 years, but that's an option. I have seen a policy that guaranteed 1 year, but because it was a clean account, boom, they got a quote for 6. So again, extended reporting provisions for cancellation or non-renewal, but that's not the only reason they get triggered. How about a change in control or a change in risk hazard? Maybe ABC Corporation has just purchased another company, and it's more than 20% of the revenue of their revenue as it currently exists. So their revenue has increased dramatically. That could trigger an ERP, meaning we're not covering any wrongful acts of this company you just acquired unless you tell us about it within 30 or 60 days, and then we reserve the right to quote additional premium to cover the new entity you have acquired. Same is equally true if your company gets acquired. You merge or get acquired by another company. Most claims made policies immediately convert to extended reporting. They won't cover any wrongful act that took place after that transaction. The policy immediately goes into runoff, and the premium is what any unearned premium becomes immediately earned. That's what usually happens when your company gets acquired. So again, you could buy an ERP, but how long? Does the insured want more than a year? Can he get more than 1 year? That's the other problem. And they may not want to do it. It's up to the underwriter. And in addition, it's of course, how's the claim history? How's this? How's that? So you could be at the mercy of the insurance company. But overall, ERPs, have a lot of problems. They got prior pending issues. You got these problems, again, arbitration. These are all things that can affect ERPs, especially prior pending. These are very dangerous language. I love this one, first inception date, which, they never define it. So here's a dangerous omission. Separate definitions for wrongful act and coverage for third parties. So what about an endorsement that excludes emotional distress? In an EPLI policy, I've seen it. Usually you see a carve-back in the definition of damages. Damages does not include emotional distress unless it arises out of a wrongful employment act. But they took that out by endorsement. And I called the underwriter. Am I reading this right? She says, yeah. I says, 99% of all damages in an EPLI claim is emotional distress, and you're excluding that? What am I selling here? And I got a bunch of corporate gobbledygook about measuring pricing against the risk and hazard and blah, 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 blah. I said, I don't want to hear this garbage. Either give me an endorsement or either cancel this endorsement so that emotional distress is covered, or close your file. Third party wrongful act, don't take that for granted either. We all know that on EPLI policies, we want non-employee claimants, people who are maybe customers, to be covered. We want the insured covered if a non-employee makes a claim for discrimination or harassment of some kind. But the definition of what is a third-party wrongful act varies. It could be limited to customers. It may not be as broad as with whom anyone the insured interacts, which is the broadest language around. That's the language you want. We want to make sure that our third-party extension covers anyone with whom we interact, not just a customer. And then, of course, what if the definition of damages includes emotional distress, by a employee? Is emotional distress covered if it's alleged by a non-employee, a third party? Don't take it for granted. Don't take third-party coverage for granted either. Sometimes the policy says we cover it, but only if the box is checked off on the declaration page. That's how technical it has gotten. So these are concerns. Now, another thing, absolute BI exclusion in an EPLI policy. We've seen that. Absolute language that no bodily injury is covered, including, emotional distress. Really? And of course, there's another gotcha that'll get you. More dangerous language. This is a third-party issue. Current or former customer, there's your limitation. Now, let's talk about mergers and acquisitions, because this is what I've been waiting for. Mergers and acquisition always trigger the extended reporting provision as soon as the deal's closed. And that's, again, another reason why you want to have as many years as you can get for what's called the runoff. The company's being acquired, but they could still be sued for something they did before the date of the acquisition. So you got to have more than 1 year. Here's the problem with this. Number one, you're taking one limit of liability, whatever it is, $1 million, $2 million, $3 million, whatever the limit is, and you're extending that out over 1 year, 3 year, 5 year, maybe as many as 6. Okay. Doesn't take a lot of claims to kill $1 million. And those limits do not renew. So you're taking one limit, spreading it out over multiple years. So that's a problem. Number two, eventually the runoff, the extended reporting provision is going to run out. Now what? Got a gap in coverage. Now, could a lawsuit be made against the directors and officers or against the owners of the former company after 4 or 5 years? Maybe. It happens. There's a lot of reasons for it. Equitable subrogation is one of them. Like A sues B, pays it, settles it after several years, and now B wants you to contribute, your company to contribute. So that's called equitable subrogation. So now, what do? You sold the company 4 years ago. Your extended reporting coverage or your runoff coverage expired after 3 years, and here you are, got a claim that's not covered. Or maybe they're going to sue the parent the new company that acquired yours, and you get a phone call while you're retired in Italy saying, "Oh yeah, we got a claim against you. You got to pay it." Good luck. Good luck. It's not easy. It's going to track you down. And of course, the buyers left holding the bag on something they had nothing to do with. So let me give you some creative solutions to this. If you understand the problem, then the solution is staring you right in the face. When I sold my company to a much bigger company, I didn't have to buy an extended reporting provision. I didn't buy that. Here's what I did. First, I asked for a B of R from the new parent company. I said, your renewal's coming up around the same date we're closing. You're buying one of the best, E&O firms around. Why don't you give me a B of R to handle the renewal of the corporate E&O? And they said, fine, yeah, it makes perfect sense. So they gave me the B of R. So I sent it into the expiring carrier. Meanwhile, I called up a couple of underwriters that I knew at the time were players. I don't think they are anymore due to acquisitions, but still, I called a couple of underwriters and I said, hey, I got company A for an insurance broker E&O policy. Here's what they do. Here's what their revenue is. Their loss history is really clean. Here's the current premium. Here's the current deductible. Would you like to write that? And you think you can improve on it? Oh yeah, absolutely. But we'll need an application and blah blah blah. I say, oh yeah, that's taken for granted. Now here I got another one. Another company, same thing. Good company, good management, smaller in revenue, approximately X, Y. Here's the revenue figures. Excellent claim history. Would you write that one as well? And they said, oh yeah, we'd look at both of them. I said, okay. What if A buys B? Suddenly B bad, and you're gonna write it retro date with a retroactive date for B, the date of the acquisition, and force B to spend a lot of money buying ERP coverage and whatever. Whereas if they both applied separately, they're good companies, and you'd write them. Explain to me the logic of that. So the underwriter's like pretty smart, and he says, "Fred, are you selling your company?" And I said, "Yeah, I am, but obviously you need to keep that confidential." And he says, send us the applications. We'll look at them. But yes, we would do that. Wow. One other thing. Every one of these policies, all claims made policies, have a condition in them that we don't cover any wrongful act that takes place subsequent to a transaction. We don't cover any prior acts. So I said, well, if you're willing to do it, we do have to amend the transactional condition that you don't cover any wrongful act prior to the date of transaction. I mean, just issuing a retro date for the my company and honoring our retro date isn't enough. You got to also say that the transaction condition does not apply to the Fisher, whatever transaction. And they said, fine. Okay, so I went to another second insurance company, same pitch, same answer. Yes, we'll look at it. If they're clean applications, we'll pick up all the retro dates for your company. We will also amend the transactional limitation that makes it clear we don't cover any claim arising from a wrongful act prior to a transaction. It's perfect. So then I call the incumbent carrier. I'm not going to mention names. They laughed at me. I told them I had 2 quotes. I don't lie. I don't bluff. They should have known that. And they said, no, we're not going to do it. You're going to have to buy tail. I says, fine, close your file. You're going to lose the renewal. I don't lie. I don't bluff. I've told you what the terms are. I've told you what the premium is. I've told you what the deductible could be. I told you had to match it. So fine, close your file. They didn't believe me. So we're getting real close to renewal. We're 4 days away. And I get a call from the local marketing person. Fred, what's going on with the such and such account? They're freaking out in New York. I said, really? What did they tell you? They said they're ready they gave you a great quote. They're ready for an order to bind. I said, did they tell you about the problem I raised? And she says, what problem? So I laid it out for her. They said no. They laughed at me. You know me well enough to know I don't bluff. So she said, I'll call you back. Well, she didn't. Half an hour later, the underwriter in New York called me back. Said, okay, we'll do it. I said, here's what I want. I want to see the language. I want to see the endorsements now, because I'm not going to end up binding with you and then finding out that the endorsements you're willing to do aren't what I want or need. And then I've got no leverage and I have no power. So I want them now. Number two, I've told you what the terms were from the other companies, and you're still sticking with your original renewal terms. So you're charging us more premium, you're giving us a higher retention, and I don't have the endorsements. So unless you can do better, it's done. You're gone. And don't go screaming to management that, Fred Fisher was disloyal and blah, 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 when I gave you every opportunity to quote on this 3 weeks ago. And they, guess what? Lost the renewal. So you can negotiate. Granted, for a $2,500 premium, they probably wouldn't have done it. But this was some serious six-figure money. So we were able to get that done. So be aware. Let's talk about my favorite exclusion, the one that takes the cake. Company shall have no obligation under this policy to make any payment of any kind for either damages, claim expense, or coverage involving workers' compensation. That's in the construction policy. Can you imagine? Any claim for bodily injury or death, benefits from bodily injury or death are collectible or compensable under any workers' compensation law or disability benefit law. Wow. Really? This was in a liability policy, and they had how construction cases go, there's lawsuits flying all over the place. And this one excluded any claim that could be covered by a workers' comp policy by anyone, not the policyholder's workers' comp policy, anybody's workers' comp policy. So even though the claimant had an accident, he was filed suit against somebody else, he was being paid workers' comp by his employer, made the claim against the insured for liability, for what happened, and they had this in it. Are you kidding me? Like, oh my God, these are gotchas that'll get you. Okay, so let's remember something. Making a profit by an insurance company, uncertainty increases costs and expenses. Unnecessary uncertainty increases unnecessary litigation, declaratory relief lawsuits. It's bad enough you got a claim against the insured. Now you're going to sue them and say, we don't cover you, and the insured's going to sue you back for bad faith. That's 3 lawsuits or 4 lawsuits, including the original one, out of one claim. That's not sustainable. Uncertainty can turn one claim against the insured into 4. And of course, can doom a problem, can doom a program, because it's unsustainable activity. So these are things that happen. So let's talk about the gotchas. They can be in the insuring agreement, tied to claim reporting conditions, definition of claim, and extended reporting provisions. Prior pending exclusions, dangerous. Time bombs to report claims and report potential claims. Absolute exclusions that don't refer to the insured. The definition of claim, potential claim, wrongful act, and professional services are all potential gotchas in claims made forms. Carve outs and carve ins, as we saw with the EPLI thing, where they're carving out, emotional distress. You may not even have third party coverage for based on the definition of a third party or at all. Merger and acquisition, changing control issues. There's ways around it if you can be competitive, or you can be creative. Diminishing limits. Is $1 million enough anymore? especially when the policy limits are reduced by defense costs. And allocation of covered and non-covered items. That's another one where, well, we're spending money defending you, but we don't cover these items in the lawsuit. And so there's the allocation language that can exist as well, especially in D&O policies. So these are some of the things that you need to be aware of. So bottom line, thank you all. We'll take questions. And I don't know what the rules are here for you folks. I'm willing to stay online for as long as we've got questions. I'll be happy to do that.
Well, Sue, Sue, there's one question in the Q&A. Do you want to?
I see that. Will a carrier change a form if you request specific language?
Well, they might decline the account. That's possible. That's why, you know, as I mentioned in my own case situation, I had the quotes in my pocket before I went to the incumbent. So, you know, I wasn't going to gamble like that. I either could get what I needed, but I never bluff. I never bluff. I had the quotes. But you can always ask. And then, of course, you'd be surprised what you can do depending on how much business you had with an insurance company. I remember the one carrier was issuing a prior pending exclusion of inception, even though the insured had prior X going back 10 years. That creates a gap in coverage because a last minute lawsuit that's filed against the insured that they don't know about would trigger the expiring policy, but wouldn't be covered by the renewal when the lawsuit was served because of the prior pending exclusion. And I told the insurance company, either you match the retro date with your prior pending date, or you're not getting any new business from me where the insured has prior coverage and a prior act date. And they saw the volume of new submissions drop by 80%, literally overnight. Within 2 weeks, I got a call back saying, we'll do what you want. Because we weren't sending them any new business. Or at least we weren't sending them any new business where the insured had prior coverage because they weren't willing to honor their prior pending date was inception. That creates a gap in coverage. And it's happened that we had that problem happen 19 times. Fortunately, we did the right thing and none of them were denied.
If I could just comment, Frederick, excellent, really, really was, and appreciated that excellent topic. We had obviously a very good crowd and they all stayed. So they were taking notes and listening. So that is really great. And we appreciate you coming today to do this.
Oh, it's my pleasure, and thank you, MSO, for sponsoring it. I want to assure everybody that the book Claims Made Insurance will either help cure insomnia or it will go into far more depth than we had time to do today.
Yeah, good. Sue, closing comments.
Thank you again. Our next webinar will be May 15th on picking the right farm policy and underwriting with our own Rich Polkowski. And June 3rd, Catherine Dorr from Hawaii will be doing a 2-hour presentation on artificial intelligence and its impact on insurance. And once again, we'd like to thank our presenter. Thank you, Frederick. Thank our team that has helped put on the presentation and keep us all in line. Thank all of our sponsors and thank you everyone who attended. Hopefully we'll see you in another webinar soon. And please complete the survey that we'll be sending you. Thank you.
My thanks to Sue as well for putting up with me the last couple of months and getting this put together. Thank you so much, Susan. I really appreciate it. And thank you again.
Thank you, everyone.